2 years ago, the government was forced to completely withdraw the 2024 finance bill following massive nationwide protests. The public was outraged over what they saw as aggressive overtaxation. Now, the National Treasury has drafted a completely different playbook for 2026. Instead of proposing higher tax rates to generate revenue, the government is officially pivoting to strict enforcement and compliance. This strategy is anchored directly in Article 201 of the Kenyan Constitution, which legally mandates that the burden of taxation must be shared fairly across society. To meet that mandate, macroeconomic policy is shifting. Rather than squeezing more money out of the small pool of formally employed people, the Treasury is attempting to cast a much wider net, capturing millions of individuals and businesses that previously operated outside the system. To prove this new system is actually fair, the government is offering a significant concession, zero-rating the pay-as-you-earn income tax for anyone making 30,000 shillings or less. The intent is for the financially strong to carry the weak. But that constitutional fairness comes with a massive catch. To make the math work, the state is rolling out incredibly strict, inescapable new compliance rules and filing deadlines that will impact the everyday hustler. The Treasury's first major mechanism is compressing the timeline for filing taxes. For regular taxpayers, the traditional June 30th deadline is pulled forward to April 30th. For unemployed youth and inactive businesses, nil returns are now due January 31st. The standard grace period is over. By drastically reducing administrative drag, the KRA can instantly sort active contributors from inactive entities and penalize late filers immediately. The government is also expanding the base by removing the need for complex financial tracking. Instead, they are implementing instant upfront taxation on informal trade. A prime example is the new presumptive tax, aimed specifically at the importation of secondhand clothes, commonly known as mitumba. This diagram shows the exact math applied at the port. The KRA assumes a flat 5% profit margin on the total customs value of the clothing. From that assumed profit, the government takes a one-off 30% cut before the container is even released. The tech sector faces a similar strategy. Mobile phone taxes are being collapsed into a single excise tax at the point of purchase. This aims to keep digital access wide while ensuring the KRA gets its cut instantly. Because this tax is finalized at the point of entry, a mitumba trader no longer needs to maintain complex income records. The KRA secures its revenue up front, effectively clearing the trader of further tax obligations for those specific goods. The final mechanism captures money in motion, turning everyday digital payments and lifestyle transactions into automatic tax touchpoints. The state is reaching further into personal living situations by proposing an increase to the monthly rental income tax rate, bumping it from 7.5% up to 10%. Digital platforms are also targeted. The bill introduces a new withholding tax on interchange and merchant service fees, allowing the state to capture a slice of the massive revenue generated by financial technology and card companies. Hobbies are taking a hit too. The government plans to enforce a harsh 20% excise tax on all betting and gaming winnings. The tax base is no longer restricted to your monthly salary slip. It has invisibly expanded to surround your housing payments, your digital swipes, and your weekend leisure activities. The reality for the Kenyan taxpayer is clear. The KRA's net is wider, the filing deadlines are much faster, and the collection systems are smarter. In macroeconomic theory, if this base expansion strategy actually works, the crushing financial burden on the small pool of traditional taxpayers should lighten as more informal sectors finally chip in. However, these accelerated deadlines create a much narrower window for compliance. For thousands of citizens, missing the new January deadline for a nil return will trigger automatic administrative penalties before they even realize the filing cycle has changed. This highlights the importance of Article 201, which establishes public participation as a mandatory constitutional right. Kenyan citizens have a legal seat at the table throughout this budget process. Remember, the 2026 finance bill is currently just a proposal. It has to go through Parliament and extensive public debate before it can ever be signed into an act. You need to understand exactly how these changes impact your money. Review the bill, submit your feedback, and make your voice heard before it becomes the law of the land. Stay smart and stay compliant.